Good afternoon, ladies and gentlemen. Welcome to the INCE Group PLC investor presentation for the results for the year ended 31st of March 2021. Without this presentation, investors will be in listen-only mode. Questions are encouraged at any time and can be submitted by clicking on the Q&A tab at the top right-hand corner of your screen. Simply click Q&A, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and you'll be notified once they're ready for your review. I'd also like to remind you this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Adrian Biles, CEO, and Simon Oakes, CFO of INCE Group PLC. Good afternoon.
Good afternoon. This is Adrian Biles. I'm the founder, CEO, and a 16% shareholder in the group.
And my name's Simon Oakes. I'm the CFO and have been enrolled for the last year.
So we're pleased with these results. They've been produced against a difficult backdrop. Our business, I think, is particularly susceptible to the difficulties that COVID has presented us with because, it very much depends on the collaboration between the international network offices. And while that's been relatively successful and the overseas business in particular has performed well, the absence of physical travel, I think, has had an effect. It's difficult to quantify, and it's also difficult to complain, when you're slightly ahead of the revenue level and you've maintained your operating profits before underlying items. So I think, the area that we'll focus on, I think that's been disappointing has been UK disputes for reasons relating really to government guidelines and policy rather than any inherent weakness in the business. So where we are disappointed, I think we've got very good reasons why that's happened. There's nothing irrational or odd about it. It's just, the way the chips have fallen. Strategically and operationally, we've made a lot of progress, practical progress with new offices in Cyprus and Abu Dhabi. Abu Dhabi is an asset finance business. Existing very experienced chartered accountants and banker team. And that fits very nicely with James Stocks, which we're renaming INCE Corporate Finance Limited. And those two businesses together actually present, a really good corporate and asset finance presentation to clients, which I hope is going to be very interesting. So that's the rationale for Abu Dhabi and the rationale for bringing Stocks into the group, which you'll see in the preliminary announcement. The office in Cyprus is strategically useful for Piraeus. Those two offices will probably come under common management, and Cyprus fits very well with Gibraltar, Piraeus and Hamburg in terms of ship arrest activity, which is one of our core activities. The collaborations on the strategic front are with marine cybersecurity, which is an increasingly important area because while vessels are owned by ship owners, the vessels themselves are increasingly computerized. So the threat of cyber attack is very real, and we've got a proper offering to help the owners deal with that. And there's a strong insurance application and implication of that in due course. The real estate KYC product is an online know your client source of funds product. It's very important for compliance. Most entities that hold client money, take client money, have to have something like this. We use it in our own business. We've successfully put it into other law firms, and we're hoping that it'll get some real traction in real estate. Practice management system has been successfully installed everywhere. That's terrifically important. It's the thing that underpins the management reporting, management information. It's our own. We don't have to pay license fees on a per head basis or any basis to a third party supplier who might or might not go on supporting the product. And we consider it to be, again, a differentiator and important. We've successfully transitioned to agile working. I mean, I think the reality is that agile working was more common than not in the INCE group in particular when we took it over. And I just think, the pandemic has enabled us to crack the egg, if you like, of presenteeism and that sort of stuff. And I think, it's worked pretty well. There will be a reduction, I think, in floor space in all of our offices, probably of about 50%. But we can't say for sure. I think it's going to slightly depend on how things pan out after the summer and then in the new year. The key account management program is a client care program, client-led. We must be client-led. We must be client-focused. Client really ought to be the first word out of our mouth in the morning, and that's what we do. And the last word out of our mouth at night. More than 10 new partners recruited, all very high quality. Simon will move on to the difficulties that some of them being high-end international practitioners have had in embedding themselves with the absence of travel. And we've strengthened the board and appointed a female board member, which I think is very good and we're very pleased by.
So turning to the next slide, on this slide, we just set out the sort of key metrics that we look at in terms of what the business needs to deliver. And I'll talk in some more detail about these on the next slides, but clearly revenue growth and the maintenance of a good level of gross margin is important for us. Gross margin is measured after the costs of the fee earners, including the partners, and our P&L presentation, which I think last year and before was a little bit confusing on this front, now represents that appropriately. We then talk about a metric in terms of what do we think of as profitability, which is operating profit before non-underlying items. I'll talk in a minute about what the non-underlying items are. There are a few this year you'll see in the accounts, but that we used to talk about a measure called adjusted PBT, profit before tax. One of my frustrations was when you look at the face primary financials that on the P&L, you don't see the profit measure you use. And we agreed with our auditors a presentation where this figure, the 9.2 million, appears on the face of the P&L. So hopefully our P&L is a lot more understandable in terms of what the drivers are now. Lockup is the measure we use on working capital. It's effectively the time taken from a fee earner putting an hour down, say, on a timesheet, to the cash for that being collected from the client. So it comprises work in progress and debtors, and we look at it as a days metric. Our overhead base is the support staff that we have globally, and mainly we have in our support service function over in South Wales in Cardiff, as well as our infrastructure around lease footprints and IT, our professional indemnity insurance, and then the more incidental costs, of legal and professional fees, marketing, and other such costs. And we try to trend that down over time. I'll talk again about where we are on that and what the kind of likely profile for that to come is. Then free cash flow is another measure we use, which is effectively the cash generated by the business before the costs of any particular one-offs, of which there have been a few over the last few years related to acquisitions, and before the costs of servicing debt and drawing debt, and the costs of paying dividends and fundraising from the market. So importantly includes things like the payments of deferred consideration, which is one of the bigger items on our balance sheet from the deals we've previously done. Obviously, net debt is a key measure for us, and available cash and facilities, so the cash on the balance sheet plus the undrawn facilities. And importantly, going into this year end, we have undrawn facilities, which was not the case last year. So we did refinance in late March. To put these all into then context and talk about them, I put a summary of the last 5 years here. This is the time since we listed. So the top line growth is we were a £25 million revenue business coming onto the market. We're now, for the first time, over 100 million, and we are at roughly 10%, just below profit, as measured as operating profit before non-underlying costs. And again, you can see over time, it's averaged out that the rate of growth on a compound annual basis has been roughly the same across the both. Obviously, this last year has been a slower year. What it reflects in the top graph is effectively the impact of the INCE acquisition that took place in late 2018, the beginning of 2019. But since we did that acquisition, we have had a key goal of getting to above 100 million. So despite the challenges we've faced, we're pleased to have made that jump. And as I say, we target 10% profitability, and we're pleased to be roughly in that region. On the free cash flow front, you can see on the graph at the left, on the right, sorry, we have generated about 4.4 million of free cash flow. I'll talk about what that means in conversion terms in a minute. The important thing is this is effectively, and if it weren't for COVID, we would see it as the year that we turned the corner of unwinding the working capital funding costs of the acquisitions we'd done post-listing, the the regional acquisitions and the specialist acquisitions in the UK, which were over 2017 and 2018, and then the big INCE deal and the expansion into having an international footprint. And we think, once things improve in the market, we're on the trajectory to benefit from those eases in working capital. And in the medium term, there are a number of items where cash and cash flow should significantly improve, which I'll come to talk about. Looking at the P&L, in terms of revenue growth, so it's about 4% growth, about 3.7% organic growth. There's a small amount of acquisitive growth, but they're very limited acquisitions in the period. The only two, and they weren't really acquisitions, they were the establishment of practices rather than the acquisition of practices, were Abu Dhabi, the financing business that Adrian mentioned, and the Cypriot law firm. So we're pretty pleased with the level of that growth. There has been a level of churn in the business in the last year at the fee earner level, and we've supplanted that with some of the hires that we've made. I think conversely, on the cost side, if you look at our gross profit, we incentivize and we target the business internally on a performance at 45% gross margin. We're slightly below that this year, and we're behind from last year. There are two real drivers to that. As Adrian mentioned, we made a number of lateral hires just before the pandemic hit, and we continued on, honoured those and hired those people into the business largely in the first half of this year. Most of them are individuals with significant international practices, and for them to build their business once they get in the door here, they need to be able to travel, meet with their clients, build business. And obviously the one thing they haven't been able to do in the last year as effectively is build business. So there is a small, but we hope soon to be reversed, differential between partner costs and revenue growth. In the other production cost, the predominant component, and if you need the numbers for this, it's in note 5 to the R&S accounts. Bad debt provisions. We take a position that any debtor that goes over 180 days in age will be provided for in full. That gives us a number of sort of challenges. It's ticked up quite considerably this year. It's at about 4% of revenue, rather than the kind of normal 2% we target. And again, there is both a temporary but also a structural change, which I'll talk about in terms of the growth we've had. On the cost front, our support staff and our operating costs have stayed pretty static year on year. I think there's a couple of things to mention in there, though. One is there was furlough grant taken in the UK and some in Hong Kong and some in Singapore. And that obviously has reduced those costs. On the converse to that, we did reduce headcount. We had a plan to look at our headcount through the year, and we did do a headcount reduction. So some of that decrease will be offset by reduced headcount, and therefore a comparable increase in FY22 as we're now in this current financial year won't necessarily equate to all of the furlough grant that we're now no longer taking. The operating costs as well, there is obviously reduced spend on things like marketing and travel. Conversely, again, we did spend more on IT infrastructure. We know, and we've had feedback internally, that we need to make sure that we keep best in class on IT infrastructure. And obviously now, given where we are in terms of our footprint and our experience of the pandemic, whatever happens with people coming back into the office, in the UK, there's some level of uncertainty about that, obviously, even though things are starting to ease up. We are still going to be able, or still going to need to maintain the infrastructure to allow a number of people to allow our staff to work remotely for extended periods of time, and I'm sure in some instances permanently. The other thing that's not in here, but we haven't achieved yet, is we haven't got the Asia practices onto the same management practice management and financial system as the rest of the group. That is simply a issue of being able to physically put people over there to train and do the kind of setup of those systems. We're hoping still to be able to do that very soon once travel restrictions lift. We did manage to do a number of the overseas offices during the year, despite the existence of those restrictions. But we think that once we've done that, it'll be, there will be efficiencies to be gained in the running of the business and the managing of costs in the business. The one thing that you may have seen from the RNS that's not in here is the non-underlying costs. I just want to talk about them quickly. Note 7 to the accounts gives detail of each one of them. There are 2 items of note. One is we have 2 floors of the Aldgate Tower office in London. That's our central office. Very early on in the pandemic, it became clear we wouldn't be able to get back into the office. And in fact, it only opened last week. It also became clear that the amount of usage of the office in the medium term would not be sufficient to warrant a full return to both floors of the office. And they are on separate leases, these floors, and it is not possible in the current market to sublet them. So in agreement with the auditors, we have impaired the right of use asset that sits on the balance sheet for the 14th floor, and we have provided as an onerous provision for both the service charge costs and the rates and other costs to come. What effectively we've done is brought forward a load of costs into the P&L that will not therefore appear in this year's financials and the next year's financials. The other sort of material item in there is we did have a litigation case in our Greek law firm that we'd received independent guidance would be ruled in our favour, but unfortunately just after the year end was not, so we've taken full provision of that. Again, neither of those things are cash costs in this year, but they were sufficiently outside of the norm of what goes on with our business that we've taken them below the line. I've set out on this short profit bridge. Yellow is a decrease, blue is an increase. Most of the points that we talked about on the last page, but just to sort of tie this to the next page, the basic point here is the 3 things that have sort of gone against us this year: the partner costs, where we haven't been able to get people fully up to capacity yet since joining; the bad debt, which I'll come on to talk about with lockup, that we, if we reduce our lockup days, we'll move back in our favour; and then the split of revenue in terms of where the growth has been. And you can see that both EMEA and Asia have grown significantly, whilst the UK slightly declined. And to talk about those movements, apologies, I've got a slide too far ahead. The sort of pattern of trade at the top line, both EMEA and Asia have continued on the good trajectories they were on coming out the back of last year. They had a slight dampening of activity in Q4 last year. The pandemic affected our offices over in Asia and then EMEA and then finally in the UK through towards March 2020. But that reversed a lot quicker, and they've kept trajectory from the half year, and you can see both really strong improvements at the top line and also improvements in margin for both of those practices, or both of those areas. In the UK, the main dynamic, other than the lateral hires who just get slightly more slowly growing their practices, was the dispute resolution part of our business. And if you look at page 8 of the RNS for reference and the Chief Executive's report, you can see a little split down of the kind of high level way we look at sectors. Dispute resolution and our commercial litigation practice is one of our bigger, and has been over the past few years, one of our stronger practices in the UK. We believe it's still a strong and resilient practice. The problem is a lot of the work we do relies on access to the courts and relies on insolvency laws being in place. Both the courts have been closed at points in the year, and insolvency laws or elements of them have been suspended, and that has and continues to put a hold on the level of activity. So we hope, but we're not planning for a cessation in that hold and a nice uptick in activity there over the next few months. But obviously it does depend on what happens at the end of September when those laws are meant to be lifted. In terms of lockup and the proportion of bad debt, you can see there over on the left, the higher, most areas experienced an increase in bad debt. There was a general slowing of collections across the business. Again, that is a temporary thing in the main to do with COVID, but I think there is also a structural difference. We know that lockup over in the Asia practices is structurally higher. We know that the history, as we look back over them, is that clients pay slower, and we don't plan for that ever to quite come down to the levels you can get in EMEA in the UK. But we do expect it to reduce somewhere, and you can actually see lockup in Asia actually did reduce this year, I think because of the really strong pushes they put on collections towards the year end. In the UK, there's a sort of slight variable element in terms of we had a fairly large build-up of WIP towards the year end. When we put the trading statement up, I was keen that we just conservatively put the number at the time that we got before we agreed a couple of larger contingent balances and WIP valuation items with the auditors, which are now agreed and included, and hence we've got our revenue up at the 100.2 million. But obviously those items mean that you push up your WIP balance and therefore push up your lockup. Just quickly in terms of fee earners, there is a bit of a decline in fee earners in the UK year on year. And as the markets improve, one thing we want to keep our eye on is churn and making sure we retain and bring in talent where we need it. We have, as you can see, though, across the patch, increased revenue per fee earner in all our locations. In terms of cash flow, I talked about free cash flow. There is a couple of schedules just for reference down the back of this presentation, which will be made available after this session, where you can see exactly how you derive this from the statutory cash flow that's in the accounts. It's actually quite straightforward. There's just certain line items that are included and excluded. And as I said before, it is really around looking at the kind of normal flow of business before servicing debt and before dividend payments. In terms of working capital, you can see the thing that we've sort of done here to sort of manage. What we expected to happen was last year we had a large outflow as we funded the working capital on trading basis. You can see this through the trade receivables line of particularly the overseas offices as they were brought in at the beginning of April 2019. And we expected that to sort of reverse as the working capital normalised itself this year. And what we would have thought to see would be a sort of positive in FY21, where you see the negative 0.7. The positive isn't there because obviously the lockup built up. Conversely, to partially combat that, we did defer a number of costs and payments in agreement with suppliers, and those things are costs that we will have to work out through working capital. Now things are beginning to return to normal, and we've started doing that through Q1 in this year. And again, if you turn to the CFO report in the RNS, you can see I've made a comment on where cash was at the end of June, as some of those costs have started to unwind and come to cash conversion. Final thing on net working capital, our provisions, very high outflow last year because we were unwinding a lot of the original costs of the INCE deal. There are still a few of them that we're unwinding and paying out, but in the main, that's sort of residually dying down to nil as the remainder of the INCE deal sort of costs and acquisitions unwind over to December 2021. I mentioned below cash generated by operations that we look at some of the other costs we think are important to understand for the business. Obviously, the reason I sort of point attention to lease costs, payment of contingent and deferred consideration, which is the earn-out payments, the variable payments that the vendors earn based on the performance of their businesses post-acquisition, and then purchase of PP and intangible assets, which is the investment we made this year in infrastructure for IT, but also the funding over time of the practice management platform that we've internally developed. These are all items that we expect over the next 18 months or so to be able to reduce substantially. And I put these into a graph here and put them over on the right here. I think the key thing to understand is that on the working capital front going forward, what we're focused on is making sure we just manage working capital right to uptick our collections, improve that lockup back down, whilst at the same time unwinding some of those built up liabilities. And the pleasing thing for us was at the end of March, we took a larger facility with Investec, which gives us a bit of headroom. We've got an RCF not yet fully drawn that we can use to just manage through the peaks and troughs of working capital. And then in the medium term for cash flows, things normalise. The infrastructure spend should decrease as we finish rolling out the practice management platform this year across the whole of the group. The lease costs, we took this provision on the 14th floor, the one half of our main London office. We will, that most of our leases in the UK have short-term lease breaks on them coming up in the next 12 to 18 months. We can get out of that 14th floor in October next year. And, we can reduce our footprint in some of our other locations as well. For example, in our Bristol office, there's an opportunity to rationalise our footprint there. And those cash cost savings should start to come through. I'm not saying that we'll sort of take that number fully down, but we can probably reduce it by, 20% or so. And the deferred consideration as well, obviously, it's that unwinds throughout this year and a little bit into this current financial year and a little bit into next financial year. Some of it will be replaced by ongoing remuneration because for some of the vendors who are active partners in the group, it is their ongoing remuneration in part, but not fully. So maybe a third or so of that we would hope to get as a kind of cash upside as we exit the end of the INCE acquisition deal. And what that means is when we talk about free cash flow, if you compared the operating profit before non-underlying costs, the 9 million, to the free cash flow generated, the 4.4 million, which is in this orange box here, you'd be talking about 48% cash conversion. That is lower than we think the business can deliver in the medium term over the next couple of years. And I'd expect it to start ticking up towards 70-75%. That is me on all of the financials, except I'll obviously come back for questions as you got them at the end. Thank you, everyone.
We continue to have a growth strategy. We're able to recruit very high quality partners from firms larger than ourselves, as well as peer group and smaller firms. And I think, as Simon says, it's very important that we maintain the fee earner levels amongst the associate and senior associate group. And there are a lot of people have sat at home during COVID looking around and, thinking that the time to change is as soon as the pandemic ends. That's true of a lot of firms. And as a result, there are lots of very high quality recruits on the market. So I'm confident that we'll be able to solve any issue that has arisen there. We've forged a strategic alliance, as we'll go on to the next slide and say, we'll always look for complementary acquisitions, but they have to be ones which, satisfy all the requirements of stakeholders, shareholders, and the group in general. We are in a great position, really, in terms of having the 8 jurisdictions, the great brand, the Premier League position in maritime, and really excellent people throughout the world. As I've said, we've got a great pipeline of top talent to come into the business. A lot of those people have signed up and are working their notice, and it's confidential, or about to sign up. We've talked about the maritime business in Cyprus and the asset finance business in the Middle East. The private wealth offering is very interesting. We've got a partner who joined us from another large firm, and he's previously a UBS private banker. He knows the private wealth space extremely well. He's also a solicitor. But he's put together and organised our private wealth offering so that we have financial advice. We've got an FCA regulated wealth advisor. We've got an FCA regulated pensions advisor. We've got an employee benefits consultancy. We've got a SIP and SAS administration business. We've got a tax planning business, and we've got the legal expertise to document whatever a client might need. So I think it is a very, very interesting offering. I don't think it'll ever make us hundreds of millions of pounds, but I do think it should be capable of making tens of millions of pounds of revenue. The Chinese alliance that we've struck with Wai Heng, which is a top 10 Chinese law firm, is very interesting as well. The Chinese legal profession is very young. It's only recent that a legal profession has really been invented in China, and therefore they don't really export their legal expertise, but they do export their clients. So we're hopeful that relationship, which is already generating business, can be made into something really very interesting on the China-facing side. And as I've said on acquisitions, it would be great to find a complementary acquisition. We aren't champing at the bit, but we are enthusiastic to explore one, should it appear. So the summary and outlook is positive. Frankly, I think we feel, I say, cautiously optimistic or optimistically cautious, whichever you prefer. We're very pleased that we've got the business through the £100 million barrier. We're approaching 10% profitability, and we're generating free cash. The first quarter of the year has started positively. I know that the disputes business is having a better July than we expected. And I do think that there is a wall of opportunity for that business moving forward. It's been a banker for us the whole time that I've been involved in the legal profession. It's a very, very good department. We're doing the Sex Pistols trial, acting for John Lydon at the moment, which is very high profile. We're getting a lot of press, and obviously we've got a superb client, who pays his bills up front, which is terrific. We've got a really excellent business there, and I think that it is susceptible to this insolvency moratorium, and when that ends, whenever it is, there's going to be a catch up. I'm confident of that. So we believe we're in a good place. We're going to resume the dividend in the financial year. We've got all the resources that we need, to make the business a greater success. And please don't forget that the business has grown from £1 million of revenue in 2012 to £100 million of revenue in 2021, and it's 4 times the size it was when we listed it. So if nothing else, we've grown it pretty well. And we'd like to hand back now to IMC for the Q&A.
Fantastic. Adrian, Simon, thank you very much indeed for the presentation, and congratulations on the results. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the right-hand corner of your screen. But just while the team take a few moments to review those investor questions submitted already, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you will be redirected for the opportunity to provide your feedback in order the team can better understand your views and expectations. Adrian, Simon, we've had a number of questions submitted from investors during the meeting itself. Perhaps if I could just hand back to you to click on that Q&A tab and just start at the top, really, and read out those questions where appropriate to do so, and just give your responses. That'd be fantastic.
That's great. We've got a question here from Andrew M, which I'll take. The company is still massively undervalued versus its peers. How do you foresee INCE getting up to their valuations? We've got to go on doing what we're doing, and the company's only 4 years old. I think that some of the valuations in the peer group are quite strong. I think we tend to be. It's quite interesting. One of our non-listed peers has issued 1,000 press releases in 365 days. Now, we just don't have that many interesting things to say. I just don't know. Chief executive opens envelope. It's just not, it's just not what we do. But, we have to do more. We have to do better. So we're looking at our trade PR, at the moment. The market leader we're not using. We're using the next one. And, hopefully that's something that we can redress. I honestly think that we are just going to see one day that there's a sort of re-rating, and it will be based on the fact that we're running a business with the dynamics and the metrics to support a really strong share price, not making a lot of press releases, and really working the retail investor market. The retail investor market is tremendously important to us, of course it is, but we don't want people to invest in the business because of PR. We want people to invest in the business because of its metrics. So we will go on doing what we're doing. My view is that if we can produce free cash, profits, get rid of our exceptionals, or as they're now called, non-underlying items, we will get there.
Got another one from Andrew. You mentioned the INCE brand was revalued. It was noted the valuation far exceeds the 17 million on the balance sheet. Are you able to share what the valuation was? I don't think it's something we can't share. It was I'm just trying to think of the number off the top of my head. It was 28 million was the number. So there is a lot of latent value, but obviously accounting rules, once you've valued, that's that. Nigel M, can you please determine the quantum of impact from COVID-19, both in terms of the one-off impact to the business and the ongoing impact to future revenues, if possible? It's a great question. It's quite a hard question to answer. I think the obvious revenue impact is the dispute resolution, which is 13.9 million versus 17 million last year. So I think at the revenue top line, it's probably that's our differential, the kind of 3.1 million. We would have hoped if we'd had a good fair wind to be getting up into the kind of just above towards 105 million. In terms of other elements, it's really hard. You can tell, there's the furlough costs, obviously, that I've mentioned. The other one is obviously the bad debt, which is about 2 million up in terms of the charge to the P&L, and is a temporal thing that should reverse. Where are we on the next one?
Oh, sorry. And this is Simon C. Can you see the further use of technology to reduce admin operating costs? Yes, we certainly can. There is no doubt that the integration of all of the businesses onto the new practice management system will have that precise effect. We are currently having to reconcile two different systems, and Simon actually is probably better person to answer the question. Go on, Simon.
I think there'll be a couple of things. One is there'll be a genuine sort of improvement because there are just those efficiencies of reporting when you're on one system. I think the other thing to say about the operating costs is, if you think about it, operating costs are pretty static. There are things we can do to reduce them. There's flex in there, but a lot of it's fixed. And once you start to reduce the leasehold footprint, that'll make a big difference. Plus, once the top line, let's say dispute resolutions ticked back up and hadn't fallen off, and the bad debts hadn't gone up, well, the level of profitability, in the overheads would be quite considerably higher. So if we grow our top line a bit, you'll find our overhead rate should stay or should come down as a percentage, because the actual overheads themselves can stay static and support quite a big level of growth. Nigel M, I think this is maybe one.
Yeah, the competition for talent. I agree, it is. And I think the fact is that we're finding the market for INCE pretty good. There's no doubt that salary inflation and wage inflation amongst the fee earner body is there. But I don't think that we can, it really is our plant and machinery. Our people are our assets, and we can't stint. We've got to get the best and keep the best. So by a combination of making INCE a good place to work, having the world-class brand and the gravitas and the international network, which is extremely appealing to people, who come into the profession, in the sense that they've got many places that they can go to work. I think that we've just got to, stick to our guns, keep a decent trade press and market profile, but treat our people well, pay our people properly, and make sure that we get the best people in through the door.
Simon L, how much is and will the firm's litigation with former members of the partners, the INCE and Co, Singapore and Henry Parry Khan, Jimalakis Ledoux cost? It's in the accounts, note 7. It's the non-underlying costs. So the Singaporean partners were settled with a lot earlier in last year, around about May time, but they're not the main bulk of it. The main bulk, if you look at the litigation line, the 1.5 million, is the Greek cost, which is the cost of the settlement, and then the associated costs. Those costs have all been incurred as cash now. We do hope to recoup some of them because they're linked to the administration event of the old INCE business. And we hope to make a claim to get some of them back, but they've both been crystallised in the P&L this year and paid out in Q1 of this year.
Does INCE staff returning to the office? Yes, we do. I think it's very difficult to see precisely how that will work. I mean, I think it's important for the people in the business, especially on the client-facing side, you know, and in the revenue generation side, that the team building is tremendously important. So our sort of basic idea is that the office will be for collaboration and meetings, and productivity can be more agile. But I do think it's really important that people start coming back to the office to see one another and to see clients. And, you know, that re-entry into the world, certainly I've been doing it. I've picked up more business personally in the last couple of months than I did in the year prior to that. And, you know, that's just by virtue of being able to see my contacts and my network and, you know, actually sort of eyeball them and say, you know, have you got any business for us? And that's worked really well. And I know that my colleagues on the sales side of all businesses have had the same effect. So I think it's important that people do it. We are not going to ever go back, and weren't at, in fact, the stage where we had a desk for everybody. And I think, you know, we expect the footprint to decrease, and therefore the amount of time people will spend in the office will by necessity decrease. But I do think we need to manage it very carefully and use the office for what it's for, which is the collaboration and the human communication side.
Duncan H has got a question about share price relatively low. I think we asked a similar question a minute ago about why do we think it's low? I mean,
I think it's because people think we're going to be doing a fundraise, which we're not.
Simon L, will the firm be taking any additional redundancies in order to streamline the business coming year? We haven't got any planned. Tony D, did you say an increase was entirely responsible for the expansion lockup days? No, sorry, yes, just to clarify that point, Tony. No, it's not that the increase in WIP was entirely responsible. It's partly responsible. We still aim in the UK to keep lockup at or below 100 days, and that will remain our target for the UK. That's clearly achievable, and it was actually below that in EMEA. Over time, we expect to bring down lockup in Asia, but we accept it may be unrealistic to get it down to the 100 days.
I've just had a bit of a follow-up from one of my colleagues on the coming back to the office, and that is exactly right, actually, that training junior lawyers is incredibly important both to them and to us. So, you know, that is something that you cannot replace. You really cannot replace that. They've got to be with people. They've got to be with their peers. They've got to be, you know, with the people supervising them. You know, that's how you learn, and that's not gone away. So we're doing group days and a whole lot of stuff planned around that. And a client on a very large dispute said last week, I came to INCE due to the breadth and quality of the people. And I think that's what we've got to maintain along with our brand.
Duncan H, is the scale of opportunity by service line properly understood? Lots of talk about strategy and fairness, but no guidance on revenue targets. Is 168k fee for the UK really a big number? It's a good question. I think it varies very much by department and sector. You'll see in the accounts we've written about, you know, our sort of focus on sectors and how we structure and operationally operate the businesses. And we're looking at that, and that's going to be one of the key things we look at this year. But I think there is latent capacity in the businesses is the easiest way to answer your question. And there is clearly an ability to increase the revenue from the firm and the fee earners that we have, even without hiring anybody in the door. The metric we target people on is chargeable hours, like everybody else. And we know in parts of the business in the last year, they've sunk below that level. But our view in the medium term is that it is better to preserve the services that we've got, because where we see good, talented lawyers and good, strong businesses with good client relationships, like the dispute resolution business, we think when they return, it will have been worth the wait. Shane.
Well, I think we've kind of run out of time, guys, I'm afraid, for questions, and we will answer those that come in or that are here now. But can we hand back to IMC.
That's great. Thank you very much indeed. And thank you for covering off so many questions you have done today. And as Adrian has just said, the company will review all questions submitted today and will publish those responses where appropriate to do so. Adrian, if I may just ask you just for a few final words just to wrap up before we redirect the attendees to give you some feedback.
Thank you. Yes, I mean, I think, as I said during the meeting, let us not forget where we've come from. You know, a small office in Brook Street in 2012 to where we are today. Simon and I are, in fact, back in the office in Aldgate Tower with our head of investor relations here, Marianne. And you know, we're feeling confident. You know, we can't. I mean, Singapore's back in lockdown. Most of Australia's back in lockdown. We hope we're not going to go back into lockdown. But we're feeling positively about the future. We're feeling positively about the first quarter. I think we recognise that we can always do more on IR. I think our IR has improved immeasurably since Marianne took over as the person responsible for it, dedicated to that. And you know, I think it's very important that we continue to improve. I think there are some very interesting ideas that we've had put to us, like, you know, RNSing revenues on a quarterly basis, which, you know, as long as it's in the rules and we can do it, you know, we should do it. We want to be transparent. We want our shareholders to know what we're doing. And we're proud of our business and we're proud of our shareholders. And, you know, we want to do the right thing for everybody. So, you know, we're here working our little hearts out. I think we all need a bit of a holiday, and I'm sure all of you do too. And it'll be extremely nice when we can escape from the country without fear of not being allowed back in. So thank you very much for your attention. Thank you for being shareholders, and thank you for your support.
That's fantastic. Adrian, Simon, thank you again for updating investors today. Please could I ask investors not to close the session. You'll be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete and be greatly valued by the company. On behalf of the management team of INCE Group PLC, we'd like to thank you for attending today. That concludes today's session. Thank you.